Hey investors, today we're back for another Model Book Stock Review episode where a member from the IBD team walks you through one of IBD founder William O'Neill's most important stock trades. The Model Book stocks were paramount in helping O'Neill solidify key trading rules that we still put into practice today, and reviewing them will greatly improve your skills as a trader. So get ready and let's get to it. Today, IBD's Mike Webster will take you back in time to 1990 to examine a leader based in Thousand Oaks, California. We're looking at drug maker Amgen. This was a classic case of finding a stock with a solid chart pattern and confirming the fundamentals are strong before buying in. It also didn't hurt that Amgen had a new drug on the rise that helped patients deal with the side effects of chemotherapy. Little did investors know that the stock would increase over 50 times from its double bottom base in February 1990 through when it ultimately topped in the summer of 2000.
This is probably my favorite trade of all the Bill trades. This is one of the main reasons, no, not one of the reasons why I just love him and what he was able to do, because he didn't just talk about it, he walked it, and he loaded up into Amgen here. He missed the double bottom, and we'll get to it in market surge, but the original double bottom where is marked up there, as well as those the ads at the 3 weeks tight. He didn't even buy it there. He bought it out of that cup where it says buy at the 8-week cup right in there. That's where he initiated his position. And then he ultimately put all of his money, and by all of his money, that means the firm's capital, because that's what the PMs and Bill would trade. So he was putting the entire company at risk. That takes a lot of courage. But the way he did it was he would methodically add to it as it was working for him. He wouldn't plow 200% in long out of the gate. He would buy, and he was a master at looking at his cushion. And that's the learning lesson from this. When you study these old stocks, think how you would have traded it. So him buying it there at that cup, he would be adding to it as it was working, but he would look at the distance between what his cost basis was and where the stock was, and he'd want to make sure that they couldn't take that away from him overnight. Now, this was back in a time where you didn't have the gap downs that we have these days in the post-Reg FD, so it was a little bit different, but he would always have that. If he was trading these days, he would have adjusted for it, but he would keep that distance, and that was what allowed him to plow in and hold, and he was a genius. I saw so many other people, including myself, try to do that, and we all failed at it. No one could do that, where he would be that concentrated. And the great part of this story of this trade, and then we'll get into the specifics using my style in a second, is there where it says 5 weeks tight. During that time frame, that he went into Fidelity, which was our, consistently our biggest client on the William O'Neill side of things, and they told him that he should sell it. So here's this, they've got all these analysts, and Bill would just read the stories in the newspaper. He didn't do anything special. He didn't go out and talk to the CEO or anything. But he had this conviction in their product and what the chart was doing, and having studied historical examples for his entire life, that he knew that this stock likely had more to continue higher. So he was loaded up to his eyeballs in there, and he's got Fidelity telling him, you need to sell. And they had nothing to benefit from it, but but he had the courage of his convictions, and he had a line in the sand. And if Justin's on air, he might remember, I think it was probably around very close to where it got, like around 34 or something. I could be wrong, where if it got into that level, he was going to go ahead and have to sell. But I remember him telling me that when he bought it, and it was going into a big announcement. I think it was an earnings announcement, and he was 200% long, and it was the firm's capital, like all of the firm's capital, that, how risky that event was going to be. But he, that's what separates Bill out from everyone else, being able to do that and live to fight another day. And he made a fortune on it. I mean, he just had the ability to hone in on to that leading stock and build a massive position. So that's how he did it. So for us mere mortals, what I designed something to try to allow us to do the same thing that Bill did. And that was my quicksand and Grateful Dead rules, and those use the moving averages on the RS line. And in a nutshell, with those, yeah, we can go there. So for the daily, I use a 21 day. For the weekly, I use the 8, and then a 10 for the monthly, and that's on RS1. RS2, we use a 21 day. Uh, I'm sorry, a 50 day, a 21 week, and a 24 week. Those are the current settings, all simple. So the concept with this, and I came out of this of trying to be Bill and failing miserably every time. The buying is easy, the selling is easy, the in between is the hard part, and that's where he was really good at. And I wanted to have something that allowed me, with black and white rules, to hold a core position. So with this segment, to keep it short, we're only going to be talking about the core position, which is the quick, which is when that RS line, which is your green line, comes back down through its first line. That's the orange one. When that happens, that's your quick signal. So you sell 1/3 of your core position. Then if it goes lower, the RS line goes lower than where it initially broke through it, then that's the quicksand, and then you sell another third, and it ultimately, the Grateful Dead signal, which is when it goes through the blue line, then you sell the rest of your core. So quick, you sell a third, quicksand, you sell another third, and then finally you hold on to it until it does the Grateful Dead, and then you get out of town. That's what I use for winning positions. You cannot use that unless you're up on the position. So that's a very key sign. So let's just kind of walk through this process. And another key part is you're going to have to buy back along the way, because you're going to get shaken out. It doesn't get you in at the very beginning and hold until the very end. It does a pretty good job. But when you're shaken out with these rules, you don't buy back unless that RS line is back through the moving averages. You can use it on a daily, weekly, and a monthly. This one, we're going to focus on the weekly just because of time. So that's your double bottom breakout. He didn't buy that one, but that's fine.
Now we're going to the week of April 20th, 1990 to see what happened after the initial double bottom breakout.
Okay, so you went up, you kind of formed a shelf, 3 weeks tight in there. And the RS line, notice the RS line held above both the blue and the gold the whole time. So that signal, now you're up on the position, you're implementing these rules, and you're going to trim 1/3 if it goes below the first time it goes below that. So let's walk through this.
Next, we'll go to November 16th, 1990.
Okay, so you can see that whole way up, it held above the blue line, but it did touch the orange line a few times, 3 times, because even earlier on it touched them. So when it did, you would do it. We don't have to do it now, but you would do a change date to that Friday and see, did it actually pierce it? If it did, you would have sold some, but then you would have bought that back using the chart as that RS line was back above it. And so that's why you want to study this to see how often you're trading. And think about it, this is a weekly chart. That's a long period of time without any sell signals. I mean, that's a big deal. Then as it's forming that base up there, you do get a quick. It doesn't look like it goes lower. So you just get one sell signal. If there was a quicksand in there, that's fine, but it doesn't look like it. And then it moves back up. So you would have bought that up back right as is the concept we were talking about earlier, as it was moving back through the 50-day, because that RS line is above those averages. Okay, we can go to the next.
Now we're going to look at March 21st, 1991.
Okay, so this monster move. Now at this point, this looks like a high tight flag in spirit. Now we saw that it didn't end up working out that way, but it's worth noting that, again, you've held the whole, it hasn't given you any of those quicksand Grateful Dead signals since the last ones. It got close to it out of that breakout, but it doesn't look like it pierced it. If it did, you just buy those right back. But it's been holding above it. And so this is something where you're not having to worry using the quicksand Grateful Dead rules to hold. It allows you to not think. And that's the most important part, because the thinking is what messes you up. As, oh, the market's doing this, my stocks are doing this, or I'm fearful of this. Like, if you have a rule, and that's why I developed it, because I'm weak at holding, I needed something to lean on that I could trust. Not perfect, but look at, I mean, from that double bottom, I mean, find something better, really find something better. So now out of this, I'd be pressing the gas. And this is what's important to note. You've got a high type flag on here. If you're not going to press the gas heavy here, then you're not following the system. But it doesn't end up working out. And the important reason why I wanted to stop here is when you're doing these, you need to be intellectually honest and forget that you know that this high type flag doesn't work out. You would still treat it like, what would you do? And you should buy it there. Don't go, oh, well, the volume was less than the prior week or any of this other nonsense. That is a high type flag breakout in spirit. So let's go to the next date. So you can see that it just doodled around there. And this is the time that Fidelity was telling Bill that, hey, you need to, exit. But let's look at what was he seeing? He was saying that it was still holding up. It was no longer a high type flag, but it was just holding all of those gains. So and let's just toggle over to the market. Just pull up the NASDAQ. So that's what was going on. The market was going through, a little bit of a mess there. You can toggle to the daily so people can kind of see it a little clearer. So it's going through this correction. So of course, Amgen, after that big move, didn't have to keep going up. So we can go back to Amgen on a weekly. So with this, what is he seeing? 3 weeks tight in there, a lot of weeks where it's closing, the closing range is high in there, and then that shakeout at the end. And during that time, you did end up getting a quick and a quicksand as that RS line was going through the gold line, and then it went lower. So you would have had two sells using my system. But then once that RS line goes back through it, if the chart gives you some buy signals, you would buy it back. So even using this, you would have still held 1/3 of your core position because it didn't go below your blue line. So we can move to the next one. So we've got where you would have bought it back the week before this, as well as adding to it this week. I wanted to stop here to kind of show that it is, this is where you would buy it, and you're allowed to buy it because that RS line is back clearly above its moving averages. And no harm, no foul. You've sold some in that base, and then you're adding to it at the right time. So this is, and I was talking to Justin earlier, trying to remember where it was that Bill sold. I think he sold during those not at the top, but the 4 weeks that were down in a row in the last little cup without handle. I think he either sold there or he sold shortly after the top. I just couldn't find the old documents, but using the RS line moving averages, you can see there some quicksand in there. Then you would have bought it back, and at the end, it's get it a little choppy in there. You don't have to buy them back, but you can't buy it back unless that RS line is above it. And you can point to where the Grateful Dead signal was right there. So that using this very basic holding system that I developed and I'm sharing with everyone, and I will change it in the future. I've made a few changes as I keep testing it out, but this would have allowed me to hold at least a third of my core for that entire move. And the same thing Bill was doing with his instincts, and he was, so we're never going to have Bill's instincts, and that special sauce that he had, but you can use things like this. If you don't like these rules, develop your own. There's nothing wrong. You can use, a lot of people like using the 10-week line. I think it's just problematic. Other people like using the 40-week line. That's problematic as well. The concept with the RS line is you're trying to buy a leading stock. So by definition, an RS line that's moving up is leading, because otherwise it would be flat or going down. So while it's leading, and we're trend followers, so we're trying to catch that trend. And so you could toy around with different moving averages, or even be more incremental, and you could have 4 or 5 different moving averages. Frankly, that's something that I'll probably move towards over the years. But this is a great starting place. And I hope everyone goes through that series of things that Justin and Bill spent so much time marking up. You can learn so much from them.
Indeed. And thank you to Mike for walking us through another model book trade. They serve as a basis for so many of our trading rules and trading philosophy, so reviewing them can be eye-opening. Always remember, if you want to succeed as an investor, never forget to look both forwards and backwards in time.